The job market illusion and the truth behind the data. There's no doubt this week's jobs numbers were not good, but also in ways that are just not reported. It can be very frustrating. All this time we've been told how strong employment is, but it certainly doesn't feel that way. We're going to show you three key metrics about what's really going on in the jobs market, and you're going to see you are right to trust your instincts. Non-farm payrolls reported at a rate of 175,000 jobs following last month's report of 315. It's a continuous slide to the downside, and this is one of the worst numbers that we've seen over the past couple of years. Now, again, we're going to take a look at three key metrics that most are just not talking about. Number one, seasonal comparison. We take a look at, for example, the unemployment rate, and that was reported at 3.9%. It's an increase from last month's 3.8%, but on a year-over-year basis, it's a lot more representative. There are seasonal factors that go to influence economic numbers, different types of businesses throughout the year. So on the unemployment rate on a year-over-year basis, it's up 15% from this time last year, following last month's report of an increase of 9%. And we can see on a year-over-year basis, a continuous increase over the past couple of years. Also, average hourly earnings on a year-over-year basis, up only 3.9%. Last month's 4.1 is a little bit higher, and there's a continuous slide to the downside on the average hourly earnings. Seasonal comparison certainly is important to take into consideration. We can also consider the data sources themselves. So the popular number, of course, is non-farm payroll, but compare that to the ADP data, also reported on a monthly basis. What's the difference? Left-hand side, non-farm payroll. It's released from the Bureau of Labor Statistics. ADP is reported from actual companies. It's actual payroll data that's reported anonymously. Non-farm payroll counts private and government jobs. ADP, it's only the private sector. It's much more representative of what the economy that most of us encounter. Also, left-hand side, non-farm payroll. It's more volatile during times of crisis. The estimates are not as accurate. For example, during the COVID crisis, the non-farm payroll data just was not very accurate. ADP has a better track record. So, taking into consideration ADP private payroll employment on a year-over-year basis, we're up only 1.8%. This is the lowest number we've seen in at least several years. ADP manufacturing. Manufacturing has certainly been one of the weaker sectors we've seen over the past couple of years. It's in negative territory. It is improving, but up only, or I should say down, only negative 0.4% following last month's report of 0.7. We have leisure and hospitality, a continuous slide to the downside, up only 4.3% following last month's 4.8%. So even with the ADP data that's considered to be more accurate and more reliable, it shows us weakness. By the way, let's take a quick look at the Fed funds futures. In green, the probability the Federal Reserve will cut interest rates by 25 basis points. In white, the probability the Fed will not cut rates. We're talking about September. That's now our pivot points. What's the pivot point? When there's a greater probability the Federal Reserve will cut interest rates by 25 basis points and not leave them unchanged. The last time we spoke about this, November was our pivot point. But we're now looking at September as a month where there's a greater probability of a quarter point cut than the Fed not cutting rates. That's how bad this past month's jobs numbers were. Now, in terms of the jobs market, what's our third metric that really nobody's talking about? The trend within the trend. So we look at the JOLTS report. This measures job openings and hires and separations, all those metrics. And on a year-over-year basis, we're down 12% in terms of the number of openings, job openings. That's a decline from last month's negative 11%. We can look at the hires on a year-over-year basis. That's also negative, down 8%, following last month's negative 5%. But putting the two together, in yellow, number of openings. In blue, the number of hires. Notice, in particular, the number of hires is greater than the amount of openings, meaning, and they're both trending to the downside as well. So this essentially is telling us there are not a lot of job openings out there. Employers can offer lower salaries and less benefits. employees and applicants really have to accept, lesser roles or lesser salaries. Now compare that to the period of time in 2017 through 19. It was a different market. It was a different economy. Both lines are trending to the upside, and we can see in this case there were more openings and hires. Those of us looking for a job, we had our pick, and employers had to offer higher salaries, more benefits in order to entice us away from the other job. We'll compare the two. Left-hand side, 2017 to 2019. Right-hand side, present date. In yellow, again, job openings. In blue, hires. And we can see what's very interesting on the left-hand side, up 13% in terms of the number of job openings, exceeding, again, the hires of 5%. Right-hand side, a decline. And the job openings in this case was below the number of hires. So there's a really important takeaway from this, not only the direction of the trend, but also, again, which is greater, the amount of hires or job openings. And it really does explain what we're experiencing right now. We can also take a look at total separations. Now, that's anybody that leaves a job under any conditions, whether they quit, they're fired, they're laid off, or otherwise. Currently, total separations year-over-year basis down 12%, following last month's -5. Now, this number is quits. Those are only the people that voluntarily decide to leave. That's down 16%, following last month's 15%. And we can see something very interesting. In red, again, total separations. In green, quits. And what we're seeing here are separations are greater than quits. It's actually more accurate to say quits are less than separations because they're both trending to the downside. And what is this showing us? It's showing us right now employees do not want to leave their job. That's how bleak the job market is. They know there's not a lot out there. I might as well stay where I am. Compare that to 2017 to 2019. Both lines are trending to the upside. Business was better. So there was more opportunity out there. And in this case, the quits exceeded the separations. There were more people on a year-over-year basis quitting their job than being laid off or being fired because there was better opportunity out there. There were more job openings, better salaries, better bonuses. Compare the two together. Left-hand side, 2017 to 2019. Right side, present date. And again, total separations in red, total quits in green. And what we can see on the left-hand side, up 15% on a year-over-year basis on terms of quits versus separations, up only 5%. However, present date, the quits are below the separations. So again, the direction of the trend is important to consider, whether there's better business as there was 2017 to 2019, or are conditions worsening. But also, are there more opportunities out there? Are we leaving our jobs for better opportunities, or are we staying where we are because of the perception of lack of opportunities? Now, there's other data that also doesn't look so good, but it's hidden by inflation. We spoke about this recently. It's an industrial slowdown, specifically with the factory orders. Unfortunately, on the surface, the numbers really don't reflect the true weakness because the numbers are being bolstered by the inflation. We took a deep dive into this data, and I think you're going to find what we discovered quite interesting.